Hello and welcome back. Today we're delving into the world of mutual funds. Everything mutual funds, as far as Nigeria is concerned, we're going to talk about it today. So click that subscribe button, like, share, and let's jump into it with immediate effect. Someone once asked me to explain what a mutual fund is. I was trying to explain, you got that money together. The person was like, is it like a susu? And how do I explain? And I realized, oh yes, have you eaten pepper soup before? Assorted pepper soup, the one with all the different types of meat inside. And the person went, yeah. I was like, okay, good. And think of a mutual fund like that. All of you gather money together. So someone now goes to the market with that money and buys all sorts of meat pieces and prepares assorted pepper soup and shares it for everybody. That's basically what a mutual fund is. Yes, you can tell I'm getting hungry. So a mutual fund is a professionally managed investment pool. So instead of buying individual securities yourself, you contribute money together alongside other investors. Then the fund manager uses that money to invest in stocks or shares or dividends based on what the fund's stated objectives are. Example, let's say 10,000 of us on this platform decides to invest 100,000 naira each in the same mutual fund. The fund manager now has 1 billion naira to invest. Now, every investor owns what we call units in the fund, and the value of these units may rise or fall depending on the underlying investment performance. Okay. Unlike ETFs, we talked about ETFs in the previous video, the link is somewhere there. So unlike ETFs, which are traded on the stock market like every normal stock, mutual funds, they release their prices once daily. Normally it's at the close of business and it is based on their net asset value. Now, in order to buy a mutual fund, you have to buy it directly through the fund manager, not on the stock exchange. So unlike ETFs, you cannot find mutual funds on the stock exchange. You have to buy it through your fund managers. Now, there are different types of mutual funds, but we're going to start with the most popular, which is the money market mutual fund. Yes, we've heard about this one ad nauseum. When I started investing, this was the very first thing I heard about. So, a money market mutual fund invests money in short term, low risk securities, such as treasury bills, commercial papers, bankers' acceptance, and stuff like that, fixed deposits, other short-term government securities. Okay. The stated objective of a money market mutual fund is to preserve your capital while delivering higher returns than your traditional savings account. So if your savings account gives you like 4% per annum, if they even give you up to 4% per annum, a mutual fund will give you like 14%, 15%, 16% per annum. So it is a better way of preserving your capital than just dumping it in your bank. So what is it suitable for? It's suitable for all your funds. It's suitable for your emergency fund. It's suitable for your buffer fund. It's suitable for the fund that you keep so that you can take advantage of opportunities, your opportunity fund. It is suitable for short-term savings. For example, if you're saving for school fees, instead of keeping the money in your traditional bank account, you can leave it in, a money market fund so that interest to be added daily, and the interest is added daily. Okay, so it is good for conservative investors if you do not like taking risks at all. You want to take minimal risk. Yes, money market mutual funds is very good for you, and it is excellent for first-time investors. So if this is your first time, blundering into the investment space, I think the money market is a good way for you to wet your feet in the whole investment thing. What are the advantages of the money market mutual fund? Well, it has the lowest investment risks aside from government securities themselves. Okay, and the daily liquidity, you can liquidate it at any time, which is better than government securities. I can tell you that. It has stable returns and is an excellent place to build a savings habit. When I started building my savings habit last year, I did not have much of a savings habit. Everything that came inside either went into debt or went into investment, and the ones that went into investment eventually went into projects. So last year was a rough one. But using your money market fund, it helps you to develop a savings culture, okay? And it usually outperforms any savings accounts that you have. Take that to the bank. But disadvantages is that in the long term, it gives you lower returns compared to other types of funds that we're going to talk about. And it may struggle to beat inflation during periods of high inflation because like Nigerian inflation hits 15%, 16%, and your money market is still doing 15% or 14%. It's a struggle. And of course, it has limited capital appreciation. that your capital can only appreciate by 18% or by 16% per annum. You know it is capped. Okay, so the next type of mutual fund that I would like to talk about today is called the fixed income mutual fund. So it's like a bond mutual fund. Now, this one is similar to money market, but instead of short-term securities, it concentrates more on bonds. So it invests in things like federal government bonds, state bonds, corporate bonds, that kind of thing. And the objective is to generate regular income while preserving the capital. So it's a fixed income. It gives you regular income. It is suitable for income-focused investors, for people who are in pre-retirement and you're investing so that you have money for retirement, and for medium risk investors. The advantages that a fixed income bond has is that it has higher income than money market mutual funds, mostly, and it has lower volatility than equity funds. So it's a good form of diversification. So if you have it in your portfolio, you can be rest assured that your entire portfolio will not tank when equities tank or something like that. But the disadvantages are the interest rates. What if, for example, you buy your fixed income bond at 15% per annum, and then the interest rate goes up and other people are now offering 18%, 19%? It's not as fluid, it's not so liquid that you can just sell off easily and move on to the higher one. So you have to deal with the interest rate risks. Okay. And it has lower growth potential compared to like equity funds, and the bond prices can fall when interest rates rises. So there is that. The third type of fund I would like to talk about today are what we call balanced funds, or some people call them mixed assets funds. Now, these balanced funds combine multiple asset classes, including stocks, bonds, money market instruments, and cash. So a typical balanced fund may hold 50 to 70% equities, 20 to 40% fixed income, and a small cash allocation, depending on how balanced the fund is, and the objectives. The objective of the fund is basically to balance growth with income. So there must be growth, but it must, there must also be income coming in. And this is extremely suitable. I'm kind of dry this morning. And this is extremely suitable for moderate risk investors, long-term investors, retirement planning, and all that. For people like you and I, this is a very, very good bond. So the advantages are diversification in one investment, which I like. And it has lower volatility than pure equity funds, and it also outperforms money market funds. Okay, and there's a professional asset allocations. The disadvantage is that when there is a rally in the stock market, it really cannot capture that rally because it's balanced now. You really can't capture it. So it often sits between your bond funds and your equity funds because it's balanced. So, but it's a good if you don't like risk, okay, but you like having returns. I think a balanced fund is a good way to go. Now, equity funds. Equity funds invest primarily in the listed companies and the NGX. So they will have all sorts of equities in them like GT, like Seplat, Dangote, etc., etc., etc. The long-term objective is capital appreciation. I like this one. Okay, and it's suitable for investors with a long time horizon. Like if you are saving for retirement now, we're saving like 20 years, 25 years for retirement now. Equity funds are a good way to go. It is suitable for wealth creation, and it is suitable for retirement accumulation. Yes, it is. The advantages, they are much. Okay, so what are the advantages of it? High long-term growth potential. Yes. Benefit from market appreciation, like we saw this year, dividend income, professional stock selection, all the goodies. But the disadvantage is high volatility. When the market crash started, or rather when the bear market started, I saw my funds going from 900 and something naira to 800 or something naira. Oh, it was scary. But when I consider how much I had made already, I just rebalanced my portfolio. So the values can decline significantly during market downturns, and it requires a lot of patience. It's not the type of thing you put money in today, you withdraw tomorrow. That one's from mutual money market fund. That's not for equity funds. And the last one I would like to talk about is something called ethical or Sharia compliant funds. These ones are pretty new to me. I just stumbled on them last year. Okay, I stumbled on almost everything last year, but yeah, they're pretty new to me, and they avoid sectors that deal with things like gambling, alcohol, conventional banking, tobacco, anything that goes against Sharia law, I think. Okay, so it's suitable for investors who want to invest but don't want to offend their faith, okay, and investors that want ethical screening. We're not saying that it is only for Muslims simply because you hear the word Sharia. A lot of us are investing in it. It just shows that we're not going to invest in anything that has to do with alcohol, anything that has to do with gambling, anything that has to do with collecting interest, like conventional banking, anything that has to do with tobacco products and drugs and all that kind of thing. So, what are the advantages of this kind of fund? Ethical investment approach, diversified portfolio, and it can perform competitively with conventional funds, which we saw happen this year. And the disadvantages are smaller investment universe and they miss opportunities in excluded sectors, like those crazy things that happen because of the bank rally. Yeah, you miss all that. So if we want to talk about investing in mutual funds, what are the top 5 best performing mutual funds in the last 12 months? I don't want to use only data from 2026 because some funds did extremely well in 2026, but that does not mean they are the best performing funds in the market generally. So let's look at 12 months, okay? The number one, which surprised me because I wasn't expecting that one to be the number one, is the Norenberger Equity Fund, an equity fund, and in the past 12 months, it has done an approximate 140% return in 12 months. So if you had invested 10,000 naira in June of last year, by June of this year, you would have done about 120 to 140%. My personal favorite, the AfriVest Equity Funds, you can find it through their app, their Pluto's new app. It did 110, 110, 130% in the past 12 months. And yes, this one I benefited from it because this is the one I invest with. ARM Equity Fund, they did crazy this year. This year alone, they did over 110%. But in the past 12 months, they've just done 105 to 125%. So not much difference between them and the one I normally use, although I'm potting. Okay, there's Stanbic IBTC Nigerian Equity Fund, which is, I think, one of the most popular, and they have done about 100%, 120%. So we can see that they are all doing about 120% in the past 12 months. And then we have United Capital Equity Fund that did about 95 to 115% in the past 12 months. So let's ask ourselves, why have these funds performed so well? Well, nearly all of them that perform that well own stocks, banking stocks, consumer good companies, industrial companies, energy stocks, all the stocks that drove the rally in 2026 and even in 2025. So several factors contributed, okay? We had the banking stock recapitalization, which attracted a lot of investors. So there's that. Corporate earnings were kind of strong this year, last year, and this year, and pension funds increased equity allocations, foreign investors' confidence. They kept on pumping, they are still pumping money into the Nigerian market. And declining fixed income yields encouraged investors to seek higher returns in equity. A lot of people moved away from treasury bills and federal government savings bond when the interest rate dropped and they moved into equity. But now that the interest rate is appreciating, they started moving back. That's how the market is. No loyalties. So how do all these funds compare with each other? Let's start from the very beginning. Money market funds. Well, the expected return is kind of low, if you can call 15% per annum low. The risk is very, very low. The risk is very low. And the best investment horizon is less than 2 years. This is money that you keep so that you can have access to it to do other things. Bond funds, the expected returns are moderate, the risk is low. So the best investment horizon will be maybe 2 to 5 years. A balanced fund, moderate to high, expected returns based on how well the market is doing. The risk is moderate because yes, the price can drop sometimes, or it won't drop as rapidly as equity funds. And then these ones are long term. When it comes to the balance fund, the equity fund, and your ethical fund, the best investment horizon for them is long term investing. So, equity funds, the expected return is higher, but the risk is also very high. And then we have ethical funds, which the expected returns are moderate to high, and the risks are also high. So, if you were choosing funds, how would you now position your portfolio? It depends on your goal. If you need the money in the next 3 to 6 months, let's put it in your money market. It helps for your emergencies. If you're saving for something like a house, you have programmed in 3, 4, 5 years to buy land and build a house, you can save the money with a bond fund or a balance fund. But if you are building wealth for retirement, you should look at your balance fund, your ethical fund, and your equity fund. So, as always, if you were to ask me which fund should you start with, I will tell you, start with the money market fund just so you get the feel of regularly investing and saving money. And then once you have enough cash, you can now move some of it to an equity fund. And as your portfolio grows, you can add a bond fund or a balanced fund. And you keep on rebalancing your portfolio based on the stage of life you are in at that particular moment. So if this video made any sense to you, if that's clarified any matters for you, it has helped you in your investment journey, please like, subscribe, share, drop a comment. I would like to hear from you, and I'll see you in the next one.